Welcome to another case study by Blueprint to Escape. What if you could pay, a flat fee of $49 a month to permanently rent a machine that reliably produces $176 in cash?
That is certainly a compelling proposition.
Right. Today, we are directing our focus entirely toward a very specific type of listener. If you're tuning in, you are someone who treats your portfolio with gravity. You're a serious investor focused on disciplined, regular income, steady portfolio growth, and security.
Exactly.
We are setting a firm boundary right at the door. There are absolutely no speculators or day traders allowed in this conversation.
Yeah, the approach detailed in this case study really requires a measured, intellectually curious temperament. It relies entirely on structural mechanics, patience, and strict parameters.
It's definitely not about chasing sudden market surges or trying to time some volatile breakout.
Yeah, not at all.
And before we get into the mechanisms of those parameters, I just want to provide a really simple note on how to consume this information. We are exploring the data and the philosophy outlined in this case study strictly for educational purposes.
Right, it's an exploration of a financial mechanism.
Yeah, exactly. It's not personalized advice tailored to your individual portfolio.
Yeah.
You can, of course, speak to a financial professional to review your own situation if you choose to, but our only goal today is to examine the logic presented in the case study.
Makes sense. And the core mission of today's case study is to systematically break down a strategic approach to margin investing.
Which usually scares people away.
Oh, for sure. But specifically, the case study outlines how an investor can use sensible, tactical leverage to expand their holdings in high-income Canadian covered call ETFs.
Right, and the examples provided focus heavily on the Hamilton HDIV and Evolve Bank ETFs, right?
Yes, exactly. And the mechanism is rooted in arbitrage. You are borrowing capital at a lower interest rate, in this instance, a 3.92% annual rate from a brokerage like Interactive Brokers or IBKR.
Okay.
And then you're using that capital to purchase assets with a significantly higher yield. The objective is to capture the spread between what the asset pays you and what the borrowing costs you.
Okay, let's unpack this. If margin is traditionally viewed as risky, how does this case study redefine it as a tool for disciplined income generation rather than a gamble? Because the conventional wisdom for long-term investors is usually, just avoid debt entirely.
Yeah, well, the case study redefines margin by implementing incredibly strict boundary conditions. In the traditional sense, margin is often used by speculators to bet on the future price appreciation of a volatile stock.
Right, like borrowing money hoping a tech stock goes up so they can sell it for a quick capital gain.
Exactly. And this framework completely rejects that approach. Instead, margin is only utilized as an expansion tool on familiar, well-understood income assets that the investor already holds.
So it is never used to take a position on an entirely new ETFs, or to buy a volatile individual stock, or to invest in crypto.
Never. The case study insists on limiting margin to a maximum of 10 to 20% of the total overall portfolio.
That's quite conservative.
It is. And furthermore, no more than 25% of the capital for any single ETF can be bought on margin. It's a very controlled, isolated operation.
Right.
But perhaps the most vital boundary is what they call the LMR rule, the long margin requirement.
Right, the 30% LMR rule. We really need to look at why that specific metric is the cornerstone of their risk management. How does a brokerage actually determine that number?
Well, when you borrow money from a brokerage to buy an asset, the brokerage assigns a risk level to that asset, and that's based on its historical volatility and liquidity.
Okay, so if an asset is, say, highly volatile or newly listed,
Then the brokerage might assign it a 50% long margin requirement.
Yeah.
That means they require you to put up at least 50% of your own equity to hold it, because they're calculating a higher probability that the asset could quickly drop in value, and they want to ensure their loan is secure.
makes sense.
So the case study strictly dictates that you only apply this strategy to stable, established covered call ETFs that carry a 30% LMR.
And the reason these specific Canadian covered call ETFs get that favorable 30% rating from the brokerage is tied directly to how they operate, right?
Yes, precisely.
Because they aren't designed for massive capital appreciation. They generate income by writing call options against their holdings.
Which caps their upside, but it provides a steady stream of premium income.
So it smooths things out.
That is the precise mechanism, yeah. Because they are systematically trading away sudden price spikes for immediate cash premiums, their overall volatility is smoothed out.
And the brokerage sees that.
Exactly. The brokerage recognizes this lower volatility and grants them a 30% LMR. So by only using 30% LMR assets, you're aligning your strategy with the brokerage's own assessment of market stability.
There is also a very specific timing aspect to this operation. The case study describes a punctual approach.
Right.
It isn't just about turning on the margin tap and letting it run passively for years on end,
No, the strategy involves borrowing capital in the specific weeks leading up to an ETF's ex-dividend date.
which is the cutoff point to be on the books as a shareholder to receive the next distribution.
Right. By activating the borrowed capital just prior to that snapshot, you capture the monthly payout.
And then what way?
Well, once that distribution is secured, the investor evaluates the macroeconomic landscape. They can make a tactical decision.
Either continue to hold the extra shares or sell the leveraged portion to instantly clear the debt and roll the operation over to the following month.
Exactly.
That flexibility makes sense. I mean, why carry the interest burden 365 days a year blindly when you can deploy the capital surgically?
Right. It's about efficiency.
It reminds me of an analogy from the case study. They compared margin to a hammer. A hammer can build a house quickly, but if swung carelessly, it can destroy it.
That's a great way to look at it.
But wait, borrowing costs money. Even with a tactical approach, even with a hammer, you still have to pay for the nails. You have to service the debt.
Yes, you do.
How do they ensure the borrowing costs don't eat the profits? How does the yield actually outpace the interest?
Well, the clearest way to understand how the borrowing costs are absorbed is to look at the spread in their first example. That's the Hamilton ETF, ticker symbol HDIV.
Let's focus on the percentages in the spread, because that is where the actual insight lives.
For sure. So based on the case study, we start with a base capital of $60,000 in HDIV.
Okay, 60,000.
And without any debt at all, that $60,000 buys 2,706 shares at around $22.17.
Which generates a yield of 10.01%.
Exactly. Which translates to a monthly distribution of $501. That is the baseline factory floor operating normally.
Okay, so $501 a month. Got it.
Then the investor applies the 25% leverage cap. They borrow $15,000 from their brokerage at an annual rate of 3.92%.
From IBKR, right.
Yes. And that borrowing cost translates to a static $49 a month in interest.
So you have a flat, unmoving liability of $49.
Yes. Now, that borrowed $15,000 purchases additional shares of HDIV, 677 extra shares to be exact.
Which yield that same 10.01%.
Right. Those extra shares generate their own distribution, amounting to $125 in extra monthly income.
Oh, wow. So you're paying $49 to get $125.
Exactly. You subtract the $49 cost from the $125 extra distribution, and that leaves a net profit of $76.
So by borrowing a quarter of your portfolio value at just under 4%, you are buying assets that yield 10%. That $49 interest payment is effectively buying you $125 of real distributed income.
It is a straightforward arbitrage.
And looking at the total impact, the monthly dollar yield extracted from the HDIV position grew from $501 to $577.
Right.
That extra $76 per month represents a 15.21% boost in the actual dollar value you are receiving.
Yes.
And crucially, your new yield, based on your initial $60,000 capital, went from 10.01% up to 11.56%.
What's fascinating here is the predictability of the mechanism. Because these covered call ETFs are structured to prioritize steady distributions, the investor can calculate this spread with a high degree of confidence.
That makes sense.
By adhering to mathematical discipline and focusing on the spread between a 4% liability and a 10% asset, they have permanently upgraded a 10.01% yield to an 11.56% yield.
Here's where it gets really interesting. So you are essentially paying $49 to, quote-unquote, buy $125.
Yeah.
But what happens if we apply this exact same structural framework to an ETF that has a significantly higher starting yield?
Well, the mathematics compound in your favor.
Because the borrowing cost doesn't change, but the asset payout does, right?
Exactly, because the cost of your leverage, that 3.92% borrowing rate, remains static. Any increase in the underlying yield of the ETF directly widens your margin of profit.
Let's see that in action.
Sure, the case study illustrates this with their second example, the Evolve ETF, ticker symbol BANK.
Let's walk through the impact on bank, maintaining that same $60,000 base capital for a direct comparison.
Okay, so with BANK, that 60,000 buys 5,865 shares at $10.23.
And the distribution on bank is higher, yielding $704 per month on the base capital.
Right, that equates to a 14.08% base yield.
Okay, so 14% instead of 10,
We apply the exact same leverage parameters. We borrow $15,000.
which buys 1,466 extra shares.
Yes. And at the 3.92% rate, the cost to carry that debt is still exactly $49 a month. But because the bank ETF yields more, that same $15,000 of borrowed capital generates $176 in extra monthly distribution.
So the equation scales beautifully. You are paying the same $49 fee to the brokerage, but now it is unlocking $176 of income.
Exactly. Subtracting the $49 cost from the $176 extra distribution leaves a net profit of $127.
Let's state the final metrics for that bank operation. The total monthly extraction grew from $704 to $831.
Yes.
That extra $127 per month represents an 18.04% boost in the dollar value generated.
It's substantial.
And the vital metric, the new yield based on the initial $60,000 capital surged from 14.08% to a very impressive 16.62%.
If we connect this to the bigger picture, the static nature of the borrowing cost is the true engine of this strategy.
How so?
Well, the brokerage does not charge you more interest just because you bought a higher yielding asset. The cost is locked. Therefore, the higher 14.08% base yield of the bank ETF created a much wider, more lucrative margin of safety and profit.
So what does this all mean if I were to put an analogy to it? It's like owning a successful factory.
Oh, I like that.
Yeah, your main machines, your base capital of $60,000 are running beautifully and producing a steady output on the factory floor.
Yeah, that's right.
Margin, in this context, is simply renting one extra machine for a flat $49 monthly fee, knowing with a high degree of mathematical certainty that it's guaranteed to produce $176 worth of goods.
Exactly.
As long as the factory floor remains stable and the rented machine doesn't break down, it's pure calculated efficiency.
The factory analogy is highly appropriate because it highlights the concept of fixed operating costs against variable production.
Yeah.
However, a physical factory relies on concrete stability, and the stock market is inherently fluid. With the math looking so clean and profitable, it is vital to address the final section of the case study.
We have to talk about the risks.
We must discuss the inherent risks of holding debt on equity and why this strategy must be strictly capped at a 25% margin, respecting the hammer, so to speak.
Because even the best factory machines occasionally jam, right?
Exactly. The primary danger of leverage is the reality of amplified losses. Debt magnifies both the upside and the downside. The case study provides a stark mathematical reality check. If you were to buy an asset using a 50% margin and that asset's price dropped by 25%, you would effectively wipe out 50% of your own equity.
Wow. Your own capital absorbs the entirety of the loss, while the debt you owe to the brokerage remains unchanged.
Yes. And that leads to the second and perhaps most critical risk, the margin call.
Right, the dreaded margin call.
A margin call is not a polite request. It is a forced liquidation.
Ouch.
Yeah. If the value of your portfolio drops below the maintenance requirements set by your brokerage, they will issue a margin call. This forces you to immediately deposit more cash into your account.
And if you can't?
If you cannot provide the cash within their time frame, the brokerage will forcefully sell your assets to cover the debt.
And they will be selling those assets at the absolute worst possible time, when the market is dipped and the prices are low.
Exactly.
You are locking in a permanent loss.
That is the structural risk of any leverage. And that is exactly why the blueprint to escape strategy relies solely on low volatility, 30% LMR ETFs.
And why the debt is never allowed to exceed 25%.
Right. The entire system is engineered to create a wide buffer, avoiding emotional or greedy decision-making, and preventing a standard market correction from ever triggering that forced sale.
I think we have to push back a little on the reality of that buffer, though.
Okay, go ahead.
You mentioned earlier that the 10% LMR is determined by the brokerage. But brokerages aren't your friend, and their risk algorithms are designed to protect their capital, not yours.
That is very true.
They can change LMR requirements overnight. If the market tanks, Interactive brokers could instantly change that 30% LNR to a 50% LMR to shield themselves. Doesn't that trigger an immediate margin call regardless of how disciplined your 25% cap is?
That is an excellent challenge, and it cuts to the heart of why the 25% cap is not arbitrary. Well, if a brokerage suddenly increases the margin requirement from 30% to 50% during a market crash, your required equity jumps.
Right.
However, because you only utilize 25% of your capital for margin in the first place, your portfolio naturally possesses a massive cushion of unencumbered equity.
I see.
The 25% rule is specifically designed to absorb exactly that kind of macroeconomic shock. If you were leveraged at 40 or 50%, a sudden LMR change would obliterate you.
But at 25%, your base capital acts as a shock absorber against the brokerage's shifting policies.
Exactly. This raises an important question, though. Can the listener hold steady and stick to the 25% cap when the market inevitably dips?
Right, because the math protects you from the structural risk, provided you never get greedy and exceed that cap.
Yes.
But risk isn't just structural, it's psychological. Even with stable covered call ETFs, the market will drop. If your ETF loses 10% of its market value, your borrowed capital amplifies that paper loss on your screen.
It does.
Watching your portfolio value drop faster than it would if you were just holding cash requires an almost stoic level of emotional detachment. Doesn't this require an investor to possess a very rare ability to ignore paper losses to avoid panic selling?
It absolutely demands a highly disciplined mindset. The strategy separates the fluctuating share price from the consistent income generation.
You have to separate the two in your head.
Exactly. The investor must focus on the fact that the number of shares they hold and the distributions those shares produce remain constant, even if the temporary market value of those shares drops.
Right.
Tactical margin investing is not about gambling. It is a disciplined mathematical operation. By carefully managing the spread between a low borrowing cost and a high, reliable covered call ETF yield, serious investors can safely upgrade their yields.
Just like boosting HDIV to 11.56% and BANK to 16.62%.
Yes. The math works, provided the investor respects the hammer and controls their risks.
It is a profound shift in how we view the utility of our capital. If you can cultivate that required detachment, if you can apply this level of emotional discipline and tactical leverage to securely hit a 16.62% yield, how does that fundamentally rewrite the timeline for your own financial independence?
It's a game changer.
If your money is working 18% harder for you every single month, how many years does that shave off your working life? That's something to think about.
Absolutely.
Please post your comments or questions below and subscribe for more content about financial independence, passive income, early retirement, and nomadic life design. And let us know in the comments, who do you use for margin, if you do. Also, be sure to check the description section below for the full portfolio reveal that happens mid-month, where all the current positions are laid out. Until next time, stay disciplined and keep building your blueprint.